Can all the expenses included in the net profit of the accounts be deductible from a corporate tax perspective? Well, I've got some sad news, guys. The answer is no. Expenditure that has been deducted in the accounts but not incurred for the purposes of generating taxable income cannot be deducted and therefore must be added back to the net profit or loss. Let me give you some examples. If you are spending money on entertaining customers and suppliers, 50% of such entertainment expense has to be disallowed. I would say perhaps entertainment of staff might be allowable, but we need more clarity. So business entertainment, basically meaning entertaining customers and suppliers, 50% of such entertainment costs, it's not allowed. Any donations given by an entity to a non-approved charity or public benefit organization, such donations, if they've been included in the net profit or loss calculation, have to be added back. They're disallowed. Moving on. Guys, any recoverable VAT has to be added back. Why? The principle of neutrality. If the VAT is recoverable, you can't then also get a deduction for corporate tax. That would mean you get a double deduction. Therefore, if the VAT is irrecoverable, that would be allowed as a deduction for corporate tax. Administration penalties, I think that makes sense. If an entity has broken a law and suffered a penalty, that cannot be good for tax, and therefore such penalties must be added back if they have been deducted in the tax statements, in the accounting profit. Now, any expense incurred to generate exempt income. This is the concept of neutrality, guys. If an income is earned by an entity, but that income is exempt from corporate tax, then any expenditure suffered to generate that income cannot be allowed. Now, unrealized gains and losses on capital items. If you own a capital item, from an accounting point of view, guys, if the value of that capital items in the books go up or down, these are called unrealized gains and losses. These are gains and losses on the book value of your capital items that haven't yet been sold. Such unrealized gains and losses are not allowed for a corporate income tax purposes. So if you have accounted for an unrealized gain on, let's say, a shareholding that the entity owns, that unrealized gain needs to be deducted from the net profit because it's income. If you have an unrealized loss that has been included, you need to add that back. All right, only in relation to capital items, not in terms of revenue items. So if you have an unrealized gain on the value of your inventory in stock, that's fine, guys, or loss, that's fine. Only capital items. Related party payments. Now, I'll talk about related party in my second webinar and in a future webinar, but related party payments made to a free zone person who is taxed at 0% on receipt of that income. So again, I think this is the principle of neutrality, guys. If a free zone person earns income, receives a payment which is not subject to corporate tax, then any expense suffered to generate that payment cannot be allowed. It's a bit like any expense suffered to generate exempt income. Similarly, any expense suffered to generate 0% free zone, the income that benefits from the tax holiday, any expenses suffered for that purpose cannot be deductible, must be added back. Now, I put this as a separate heading. Guys, interest expense is really important. It's a huge part of the OECD principles. Let's be honest, profit shifting, major companies, it's far easier to shift passive income than it is to shift trading income. So it is extremely important that entities that have interest expense on loans used by, it's a concept called thin capitalization. So any interest paid by entities on their loans is allowable, but is subject to a cap. Standard method, according to the Federal Tax Authority's consultation document, this is a rather generous capping, guys. Any interest expense suffered by an entity is allowable up to, i.e. is deductible from your net profit, up to 30% of that entity's EBITDA, earnings before interest, tax, depreciation, and amortization. The UAE is also planning to set a de minimis amount, but it's the higher of. So effectively, your interest expense deduction is capped up to 30% of that entity's EBITDA. If an interest expense exceeds that capping, then the excess must be disallowed. There's a special method that will only apply to a consolidated group. I'll talk about consolidated groups later, guys. But if you are a part of a consolidated group, then the interest expense capping will apply on the group's overall position as opposed to just the entity's position. And lastly, guys, these interest expense capping rules do not apply to regulated financial services entities such as banks and insurance businesses, and businesses carried on by natural persons. So if you're an individual and you've taken a loan, any interest expense suffered by an individual, obviously who's engaged in an activity, these expenses can be deducted from the net profit. Similarly, if you're a regulated bank, guys, then the interest expense capping rules do not apply. The interest expense is wholly deductible. Now, in addition, any interest paid on related party borrowings. Now, this is really important. Potential. This is all part of the BEPS project, guys. Base erosion, profit shifting. So if you have two companies that are related to each other, effectively, if one company controls the other, they're deemed to be related. Any interest payments from one entity to another entity is only allowable as long as the transaction creating that interest is at arm's length. There's a valid commercial reason for that transaction to take place, and the related party lender is subject to corporation tax at least 9% on the interest income that it receives. All right, so if you have a related party, one in an overseas country, so if you have a overseas entity and a UAE entity, any interest paid by the UAE entity to that overseas entity, guys, is only allowable as long as three conditions are satisfied. Number one, the transaction is at arm's length. Number two, there's a valid commercial reason for that transaction, for that borrowing. And lastly, guys, the foreign legal entity that is receiving the interest must pay tax at least 9%.